Good evening, everyone. This is our first tech demo. So, in choosing what stocks to buy, our group have these key factors in mind. The first one is buy shares of companies you know that you use their products every day. Like, don't buy random companies. Second one is do not put all your eggs in one basket. Spread investments across different asset classes and industries to reduce risk. And the last one, go with the market leader. At least buy one trending stock, knowing that we have enough risk tolerance. So, based on those principles, we decided to buy 8 stocks from different sectors. The first one is NVIDIA. It's a market leader in AI data center. No other companies can provide the level of their hardware. Also, recently, they just announced partnership with OpenAI to build 10 gigawatts of AI data centers and will invest up to 100 billion progressively. Second one is Apple. Well, we love Apple products. It is the largest consumer hardware ecosystem with fast growing, high margin services growth, providing recurring less cyclical revenue. Third one is Microsoft. It's a dominant enterprise software and cloud provider that's showing strong growth. And over the past 10 years, they showed a shareholder friendly approach through dividends and buybacks. The number 4 is Amazon. We also love Amazon. It's a number one cloud provider and a massive e-commerce franchise and logistic. AWS remains the main profitability engine and has continued to grow. They're also currently building the Project Rainier, an infrastructure and supercomputer for AI data center in the future. Number 5 is ExxonMobil. It's a cash generating energy exposure, acting as a defensive hedge against inflation or energy shocks, especially with the One Big Beautiful Bill Act that seems to favor fossil fuels over the renewable energy industry. In the latest financial report, Exxon's earnings were more than double Chevron's and well ahead of Shell. Number 6 is Johnson & Johnson. It's a stable healthcare giant with durable cash flows and a dividend king, having raised its annual dividend for 63 consecutive years, good for drawdown protection and diversification. Number 7 is Visa. It's a high margin payments network that benefits from the growth and adoption of digital payments globally. And recently, Visa just launched stablecoin payments to boost cross-border transactions. And the last one is JP Morgan Chase, the highest quality consumer and wholesale banking, providing valuable diversification into financials. So after choosing the stocks, we then decided what weights to assign to them. NVIDIA received the largest single weight of 20% because of its dominant position and the significant upside potential, but we capped it at 20% to avoid extreme single stock concentration risk. As for Apple and Microsoft, they share similar, slightly lower weights to reflect their scale while managing the risk compared to NVIDIA. Amazon has an even smaller weight as its next AI project remains unproven, and the remaining capital was allocated to sectors like energy, healthcare, financials, and payments to add stability, income, and diversification beyond tech. So this is how our backtrack structure. This is based on the example provided. As for initialization, we set the starting date, set the initial cash, and the benchmark, which is SPY, S&P 500 ETF index. And then we set the stocks we want to buy along with their respective weights. Sometimes in the experiment, we want to change this number. So we add a routine here just to make sure that we add them to 1.0. And then at the end, we add each of them into the equity with the daily resolution. And then on the data, the on data routine, we start the fixed allocation orders for each of the stocks. So then we run this code and we can see the results here. So we can see the portfolio grew roughly 20% per year. You can see the compounding annual return, turning an initial $10 million into about $11.45 million. However, this growth came with a significant risk At one point, it suffered a 21% drawdown, meaning the portfolio value dropped by roughly 2.1 million from its peak before recovering. We can also see the Sharpe ratio of 0.49. It's a moderate efficiency. It earned 0.49 return units for each unit of risk or volatility, where strong portfolios usually have greater than 1.0. And then as for the beta, it's 1.07. So the portfolio is more volatile than the market, the SPY benchmark. As for the alpha, small positive alpha, so the portfolio beat the market by around 4.3% after adjusting for risk. As for the trainer ratio, we can see the moderate return per unit of market or systemic risk of 0.93. And the last one is the information ratio of 0.75. So it's a good consistency of outperforming the benchmark. In the end, the portfolio show about 20.3% annual volatility and a very low turnover around 0.36%. It is consistent with our fixed weight long-term buy and hold strategy. So the limitation from our testing here is the first one, the Sharpe ratio is still below 1.0. It suggests that the returns were not very efficient relatively to the risk taken. We also see the high volatility and significant drawdowns. It shows that risk is not controlled dynamically. And then we also see the static allocation, no adaptation to market condition. There's overweight in tech, creates a market vulnerability. It could amplify losses during broad market stress. And the last one, with the single stock concentration risk from large NVIDIA allocation, which could lead to large losses if that one stock drops significantly. And lastly, we have some improvement ideas to address this limitation. The following improvements could be adopted. First one is periodic rebalancing by adjusting the portfolio monthly or quarterly to bring the weights back to their target percentage. This enforces a disciplined buy low, sell high behavior. Second one is volatility scaling, adjusting position sizes so that each stock contributes roughly equally to the portfolio's overall volatility. This strategy will reduce concentration in highly volatile names like NVIDIA. And the last one, increase diversification by adding small exposure to other asset classes like bonds or real estate investment trusts to further diversify and improve resilience. That's from us. Thank you.